evening, everyone. 5:30 on the clock. It's time for the Money Show, the only show of its kind and India's first and only show which brings markets, top financial experts to answer all of your financial queries. I'm Mubina Kapasi, and let's talk about what we are going to discuss in today's show. It's going to be all about taxation. Joining us on the show over the next 30 minutes is Homi.B. Mistry, the partner at Deloitte Haskins and Sells. Mr. Mistry, thanks so much for joining in on ET Now. We've been receiving queries thick and fast from a lot of concerned assessees. But before I go to those, I just want to talk to you about return filing. The last date, of course, for income tax return filing has gone, whether you were in the 31st July tax bracket or even in the 30th September bracket. But I understand that the revised returns due date for FY18 has been preponed to 31st March 2019, and the revised return due date will be 1 year from the end of the assessment year. If you could just explain to our viewers in which cases does a revised return apply, what exactly do you mean by revised return, and what exactly, who would this date pertain to now?
Yeah, thank you and good evening to our viewers. Your question is in connection with filing of a revised returns. Now, in the case of a revised return, that would be applicable in case a person has found any kind of a mistake or an omission in the case of his original return. So, in such a case, that individual, if he finds a mistake or if there's any kind of an omission in the return, he or she can file an amended or a revised return. Now, the revised return date for the financial year 2017-18, that date now has been preponed to 31st March 2019. So, let me explain to you what the provisions state. Earlier, in the case of a revised return, the due date was the expiry of 1 year from the end of the relevant assessment year or completion of the assessment, whichever was earlier. So, for the financial year 2016-17, the relevant assessment year is assessment year 2017-18, and the revised return due date for the financial year 2016-17 would be 1 year from the end of the relevant assessment year, that is on or before 31st March 2019. The Finance Act of 2017 modified the revised return due date as end of the relevant assessment year or completion of assessment, whichever is earlier. So, for the financial year 2017-18, the relevant assessment year is assessment year 2018-19, for which tax returns were recently filed. Accordingly, if a taxpayer does find a mistake in his return or there's an omission or a wrong statement, he or she can revise this return. And the revised return due date for the financial year 2017-18, the last date would be the end of the relevant assessment year, that is 31st March 2019. So, it may be relevant to note that both for the financial year 2016-17 and for the financial year 17-18, if a person wants to amend or revise his return, he or she has to bear this in mind, that the last date would be to revise the return would be 31st March 2019.
Okay. So, important to note here that yes, while the last date to file your original income tax return has gone either on 31st July or on 30th of September, you can always, after that date, on spotting any error, revise the return and file it. The last date for filing your revised return for financial year 18 is the 31st of March 2019. But without any further ado, let's bring on board our questions and queries that we have been receiving thick and fast. And the very first question is coming in from Arvind Nath. Now, Arvind asks, I recently sold my shop and made capital gains of 33 lakh rupees. How can I save tax on these gains? Unfortunately, Arvind has not written whether these are short or long-term capital gains. Essentially, if he's been holding the shop for more than a certain amount of time or lesser than that, because the tax treatment and the tax incidence varies. But Mr. Mistry, for the benefit of our viewers, if you could just explain the tax management strategy for both cases, short as well as long-term.
Yes. So in case of sale of a shop, I'll address both the issues or both the scenarios where it is the short-term gain as well as a long-term gain. Capital gains can either be short-term gains or long-term gains. In the case of long-term gains, that in this case, if the shop has been held for more than 24 months, it is possible to invest the net consideration or stroke the capital gains in eligible tax-saving avenues to save tax. One of the commonly used tax-saving avenues would be investment in specified bonds. With effect from the financial year 2018-19, specified bonds should be redeemable after 5 years and should be issued on or after 1st April 2018. Such bonds should be issued by the National Highways Authority of India or the Rural Electrification Corporation, or bonds which are notified in the official gazette by the central government. The investment in such bonds should be made within a period of 6 months from the date of such sale of the shop. Another commonly used tax-saving avenue for long-term capital gains which could be explored is investment of the net consideration in the purchase or construction of a residential house in India. However, the exemption is available only on fulfillment of various conditions as prescribed under Section 54 capital F of the Income Tax Act. Long-term capital gains are eligible for a lower rate of tax, and the indexation benefit is also available on the cost of acquisition or the cost of improvement, if any. For the financial year 2018-19, the rate of tax would be 20% plus a surcharge if it's applicable. In case the surcharge is applicable depending upon the person's income exceeding a certain threshold, the rate of surcharge could be either 10% or 15%. The surcharge is applied on the tax payable. An additional 4% being health and education cess would also be applicable on the total tax, including the surcharge, if any. So, assuming the total income in this case is more than 1 crore rupees, a surcharge of 15% would be applicable on the tax, and the maximum tax rate on such long-term capital gains would be 23.92%. It is pertinent to note that the benefit of the above exemptions on account of investment in specified bonds or residential house is not available in case of short-term capital gains. Further, no indexation benefit is also available. Thus, if the shop is held for 24 months or less, then the capital gains would be considered to be short-term capital gains.
Right.
The short-term capital gains would be taxable at the applicable slab rates.
Right. Okay.
And if the total income is more than rupees 1 crore, surcharge of 15% would be applicable, and the maximum tax rate on short-term capital gains would be 35.88%.
Okay, very quickly then we'll move on to our next question. We have lots of questions coming in, so we're going to try and squeeze as many as we can. We have Sumit Nagpal, who's written to us saying, I'm a pensioner and this year I have also been reimbursed for 36,000 rupees on medical care, that's OPD expenses. He wants to know if this amount would be added to his taxable income for the year, for the fiscal year 2019. Mr. Mistry, would this be the case?
Yeah, so in the case of a pensioner who's also getting this reimbursement of the OPD, you know, one would assume that he's getting receipt of pension, and these OPD expenses, the reimbursement is coming from his former employer. So the total income of the pension and the OPD medical expenses reimbursed would be considered as income from salary and hence chargeable to tax. For salaried employees, there is now a standard deduction which has been introduced from the financial year 2018-19, which is 40,000 rupees, which is the maximum amount. Thus, a deduction of rupees 40,000 or the salary, whichever is less, will be available. The term salary includes pension. Thus, the pension income would also be eligible for a standard deduction. Pensioners will now get this benefit as they will get standard deduction which was not earlier available in the past. The budget speech of the Honorable Finance Minister had a specific mention that this decision to allow standard deduction shall significantly benefit pensioners who normally do not enjoy any allowance on account of transport and medical expenses. It is also important to note that based on the age of the taxpayer, applicable slab rates also need to be evaluated. Accordingly, if the total taxable income for the financial year 2018-19 is less than the specified basic exemption limit, that is rupees 2.5 lakhs for an individual below the age of 60, or rupees 3 lakhs for an individual who's 60 years and above but less than 80 years, or rupees 5 lakhs for a person who's 80 years and above, there would be no tax payable. Further, a deduction can also be claimed for making investments in certain tax-saving avenues, such as investments in public provident fund, national pension scheme, or in the case of life insurance premiums, etc.
Okay. Great. I hope that's been able to answer Sumit's question. We'll do one thing. We'll take a very short break right here on the show. But don't go anywhere because we're going to be answering a lot more questions and queries. Mr. Mistry will be with us. So stay tuned. Welcome back. You're watching The Money Show right here on ET Now, where we are with, of course, our guest for today, and that's Homi.B. Mistry, who's answering all of your taxation-related questions. So without any further ado, let's bring on board the next question, which is coming in from Tulika Sarkar. Tulika says she's an Indian resident and sometimes has to travel abroad to offer professional services. She is paid in her account in India for these services. She wants to know if this income is taxable. Of course, it depends on how many days you've been abroad, so on and so forth, but she does say she's an Indian resident. So, Mr. Mistry, what's your take here?
Yeah, in a case like this, in the case of a person who's an Indian resident, in such a case, the taxation of the person's income, it would depend upon various criteria, such as the residential status of the individual, the place where the income accrues or arises, and the place where the income is received. The residential status is determined based on the physical stay in the current year as also in the preceding years. Since she qualifies to be a resident and ordinary resident of India, she would be liable to tax on a global income in India. Thus, in this case, the place of receipt of income or place where the services have been rendered would not be relevant. In case she has paid taxes in the overseas country, she is eligible to claim credit for taxes paid in that country based on fulfillment of prescribed conditions under the Income Tax Act and the rules read with the double tax avoidance agreement between India and the foreign country. If there is no such double taxation avoidance agreement between India and the other country, she may still be eligible to claim foreign tax credit for the taxes paid in the overseas country, and this can be explored based on the provisions of Section 91 of the Indian Income Tax Act, read with the rules in order to mitigate double taxation.
Okay, Mr. Mistry, before I get to answering the next query, I want to talk to you about e-assessments. It's something relatively new that the Income Tax Department has brought about, and I know for a fact for the last couple of years, I have been getting my income tax refund without a lot of delay. And from what I understand, e-assessments, of course, is something in that direction. Perhaps it's a paperless form of assessing taxation and taxable income. What exactly is the process here, and what should assessees watch out for?
Yeah, now coming back, see, this concept of e-assessments is now a relatively new concept because the tax authorities don't want you to be really visiting them and filing various documents and making personal appearances. They want to go everything electronically, so all submissions they want you to file through the income tax portal or by way of emails, etc. Currently, the assessment proceedings for the financial year 2015-16, that is assessment year 2016-17, are in progress, and the due date to complete the same is 31st December 2018, which is approximately 1.5 months from now. In order to meet the government's objective of paperless and hassle-free compliances, the tax authorities have now been focusing on e-assessments rather than on physical submission of documents or paper. Thus, notices are being sent via either emails and are uploaded on the individual's tax portal. In certain cases, the email contact details may not be updated based on current records, and there are chances that the SMS alert or the email alert of notices uploaded on the portal may not be received or could be inadvertently overlooked. Thus, it is important that regular monitoring of online income tax portal account is recommended so that the notices uploaded there can be responded to in time. It may be relevant to note that in a recent case, prosecution proceedings based on the facts of that case were launched by the tax authorities in the case of an individual who did not file his tax return and who also did not respond to notices issued to him. The court held that though the assessee ultimately had a refund due, that is, no tax was payable, still he had committed an offence but by not filing the tax return and by not responding to notices as he had taxable income. In view of this decision, assessees need to be cautious in complying with the return filing deadlines and responding to all notices on time.
Okay. So it's important to always ensure that you keep checking your emails, your income tax portal account. All of that is constantly monitored. That's of course about e-assessments. But again, let's get back to the questions we've been receiving. Divakar Shetty asks, what are the tax implications of buying physical gold in terms of coins or through sovereign gold bonds? Mr. Mistry, if you could just highlight the differences in the tax treatment of making these purchases of the same asset, of course, gold.
Sure. Now, coming to the purchase of either gold coins or in the case of these sovereign gold bonds, when you buy either these gold coins or these sovereign gold bonds, there are no tax implications at the time of purchase. The gold coins would be considered to be a capital asset. Accordingly, there will be capital gains tax implications on sale of such gold coins. In case the gold coins are held for 36 months or less, the same would be considered to be short-term capital asset. If the same are held for more than 3 years, the same would be treated to be long-term capital assets. The short-term capital gains would be taxable at the applicable slab rates plus surcharge if any, and a 4% cess on such tax and surcharge. The indexation benefit would also be available while computing long-term capital gains. Also, the tax rate applicable for the long-term capital gains would be at the concessional rate of 20% plus the surcharge if applicable and the 4% cess on the tax and the surcharge. Coming to sovereign gold bonds, they are government securities denominated in grams of gold. They are substitutes for holding physical gold, and these bonds are issued by the Reserve Bank of India on behalf of the Government of India. The interest earned from such sovereign gold bonds would be taxable as per applicable slab rates, though they are not subject to any tax deduction at source at the time of payment of interest. If the bonds are redeemed on maturity, there is no tax payable on such capital appreciation. However, if the bonds are sold before maturity, the profit would be taxable as capital gains. In case the sovereign gold bonds are short-term capital assets and the capital gains which arise thereon, they would be taxable at the applicable slab rates plus surcharge if any, and cess at 4% on the tax and surcharge. In case the sovereign gold bonds are long-term capital assets, indexation benefit would be available while computing the long-term capital gains. Also, the tax rate applicable for long-term capital gains, as mentioned earlier, would be at the rate of 20% plus surcharge if applicable, and a 4% cess on the tax and surcharge.
Okay, I hope that's been able to answer your query. On that note, we're completely out of time, so unfortunately, we will not be able to take any more queries. But Mr. Mistry, thanks so much for patiently answering all of our viewer queries. Then we'll wrap it up on this edition of the show. Come back tomorrow, and of course, we'll continue with personal finance right here on The Money Show.